I have to be honest, when I started reading through the stack for this deep dive, I hit a piece of information that just stopped me cold. I actually thought it was a typo at first. I'm looking at a report about U.S. Federal Reserve or Fed intervening to help, prop up the Japanese yen. I'm just sitting there thinking, wait, hold on. Since when is it Uncle Sam's job to save another country's currency? That feels like a massive geopolitical red flag that, nobody is talking about.
It is a massive red flag. It's one of those headlines that kind of gets buried under market technicalities, but it's actually a siren going off. One of our sources even called it the "it is happening" moment.
Right, yeah.
Basically signals that the polite, quiet stability we've always associated with Japan is, well, it's effectively over.
See, that's the thing. For my entire adult life, and I'm guessing for most people listening, Japan has just been there. It's like the furniture and the global economy. It's reliable and makes high-quality cars and PlayStations. The population is getting older. Growth is slow, but it's always, always stable. It's never the thing that keeps you up at night.
And that perceived stability is exactly why this is so dangerous. We've treated Japan like a background character for, 30 years? But the thesis of this whole deep dive is that the background character just walked to the center of the stage holding a stick of dynamite.
Because the bond market is cracking.
It's cracking. We are seeing yields on 30-year government bonds hitting levels we haven't seen since the late 90s, and the yen. My gosh, the yen has been in a free fall.
And we're not talking about some emerging market here with a fragile government. This is the fourth largest economy on Earth.
Sitting on a $10 trillion pile of debt.
That is the number I want to circle, $10 trillion.
It's an unfathomable number. And the critical takeaway here, before we even get into the math, is that when an economy this size starts to shake, the earthquake doesn't stop at the border.
No.
It spreads to the U.S., to Europe, to equity markets everywhere. If this crack widens, it impacts everything from the price of your mortgage in Chicago to the value of your retirement account in London.
So even if I don't own a single share of Toyota or Sony...
Even if you couldn't find Tokyo on a map.
Okay, that's a bold claim. So I want to challenge that, but first we have to understand the mechanics of the disaster itself. Let's get into the scary math you mentioned. You said $10 trillion in debt. But the U.S. has more debt than that, right? Why is Japan's situation so much worse?
It all comes down to the ratio. We look at debt to GDP, so what you owe versus what your entire country produces in a year. The U.S. is high, sure, around 120-ish%, depending on how you count it. Japan?
What are they at?
They are at roughly 260%.
260. So they owe more than 2.5 times everything they make in a year. If I went to a bank with a debt-to-income ratio like that, the loan officer wouldn't just deny me. They'd probably call security to escort me out of the building. How does a G7 nation even operate like that?
By living in a fantasy world of zero interest rates. This is where the rubber really meets the road. For decades, Japan's interest rates were effectively zero. Sometimes they were even negative.
Which is the free money trap the sources kept mentioning.
Exactly. Think of it this way. Imagine you have a credit card with a $10 million balance. That sounds terrifying. But what if the interest rate on that card is 0%? And the bank promises it'll stay 0% forever. You could just make the minimum payments and live your life. It costs you almost nothing to carry that massive, massive debt.
So the government could just keep rolling it over, put it on the tab.
Correct.
Yeah.
But now the bank has changed the terms. The 0% era is over. Rates are rising. And suddenly the service cost on that $10 trillion is just exploding.
Yeah.
Right now, roughly 25% of Japan's annual budget goes just to servicing the debt.
Wait, hold on. A quarter of the entire national budget.
Yes, and that isn't paying down the principal. That's just the interest. That is money that's not going to infrastructure, not to healthcare, not to defense. It's just dead money. And as rates tick up even a fraction of a percent, that 25% starts creeping toward 30%, 40%, and eventually the math just breaks.
Okay, so the credit card bill is finally coming due, but why now? Japan has been defying gravity for 20 years. There is a term the sources kept bringing up that seems to be the culprit here. Yield curve control, or YCC. This sounds incredibly technical, but I get the sense it's actually pretty simple. What were they really doing?
It sounds complex, but you're right. It's basically price fixing. The Bank of Japan decided that to keep the economy moving and that debt cheap, they would not allow interest rates on government bonds to rise above a certain level. Let's just say 0.5%.
So the market wants rates to go up, but the bank just says, no. How do they even enforce that? You can't just ask nicely.
You enforce it with a printer. Every single time the interest rate tried to go up, the Bank of Japan printed new yen and bought unlimited amounts of their own government bonds.
Yeah.
When you're a massive buyer of bonds, you force the yield down. And they did this so aggressively that they completely broke the market. Get this. The Bank of Japan now owns more than 50% of all outstanding Japanese government bonds.
They own half the market.
They became the market. They're the whale in the kiddie pool. There's no real market left. It's just the central bank bidding against itself. But here's the problem. Printing all that money to buy bonds creates a huge side effect.
Inflation.
Correct. And currency devaluation. Which brings us to something called the carry trade and why the yen is crashing. This is a term listeners really need to get. The carry trade.
I've heard this described as picking up nickels in front of a steamroller.
That's the classic trader definition, yeah. The carry trade is simple. You borrow money in a currency where interest rates are super low, like Japan's yen, and you invest that money in a currency where rates are high, like the US dollar.
So I borrow 1,000,000 yen at 0% interest, I swap it for dollars, and I buy a US Treasury bond that's paying 5%. I just pocket the 5% difference. It's literally free money.
It was the easiest trade in the world for years. But to do it, you have to sell yen to buy dollars. And when everyone in the world does that at the same time, the yen crashes. Because the U.S. Fed was raising rates aggressively to fight inflation while Japan just stayed at zero, that gap got huge. Everyone sold yen.
And now the yen is at multi-decade lows. Which brings us back to the real people living there. I think we sometimes forget that a currency collapse isn't just a chart on a screen. It's the price of milk.
It's the price of everything. Japan imports almost all of its energy and a huge amount of its food. When the yen is weak, all those imports get incredibly expensive. So now you have inflation running near 3% or even higher on essentials. For a country that hasn't seen prices move in 30 years, this is a profound shock to the system. Households are getting squeezed.
So here is the trap, and tell me if I'm reading this right because it feels like a total pick your poison scenario. The Bank of Japan has two choices. Option A, they stop printing money and let interest rates rise to save the yen and stop inflation.
Right. But if they do that, the interest payments on that $10 trillion debt explode and the government potentially goes bankrupt. The whole system freezes.
Okay, so that's a bad option. Option B, they keep rates low to save the government's budget.
But to do that, they have to keep printing money, which destroys the value of the yen, kills the purchasing power of their own citizens, and angers the rest of the world.
So they're stuck.
They are completely and utterly stuck. They're trying to thread a needle while riding a roller coaster. They are slowly letting rates rise, ending that yield curve control. But they are terrified that if they move too fast, the whole house of cards just collapses.
This is where we need to zoom out. Because I know there's a listener in Des Moines or Manchester thinking, okay, this sounds tough for Tokyo, but why does my mortgage rate depend on this? You mentioned Japan as a whale. How does the whale splashing around over there get me wet over here?
It comes down to $1 trillion. That's the number. Japan is the single largest foreign holder of U.S. government debt. They own over $1 trillion in U.S. treasuries.
They bought our debt with all that trade surplus money over the years.
Exactly. Now imagine Japan enters a real crisis. They need cash to prop up the yen or maybe bail out their banks. Where do they get that liquidity? They have a piggy bank, and that piggy bank is full of U.S. treasuries. They might have to start selling them.
And we know from Econ 101 that when you dump a massive supply of something on the market, the price crashes.
Right. But with bonds, you need to think about the seesaw analogy. Think of a bond like a seesaw. On one end, you have the price. On the other end is the yield, which is the interest rate. If Japan starts selling treasuries, the price end crashes. It hits the ground, which means the yield on the other side
Shoots up into the air.
shoots up into the air. And since U.S. Treasury yields set the baseline for everything else.
Everything else follows. If the 10-year Treasury yield spikes because Japan is selling, then U.S. mortgage rates spike. Corporate borrowing costs spike. Auto loans spike. So literally, if Japan loses control of its bond market, it becomes more expensive for me to buy a house here in the U.S.
That is the direct transmission mechanism. And it works the other way, too. If the yen stays super weak, Japanese exports become incredibly cheap. That hurts U.S. and European manufacturers who can't compete. It's a global, tangled web. We are financially joined at the hip.
That makes the background noise of Japan suddenly sound a lot louder. But I want to pivot to the other side of this. We've talked about the financial engineering, but there's a physical reality in Japan that makes this debt problem almost impossible to solve. The demographics.
The unforgiving math, as I like to call it.
We always hear Japan is aging, but the sources painted a picture that is, honestly, kind of bleak.
It is more than just aging, it is shrinking. Japan's population peaked way back in 2010. They're projected to lose about 25 million people by mid-century. It's like the entire population of Australia just vanishing from the tax base.
And usually a weak currency like we're seeing now would at least trigger a tourism boom, right? Japan is on sale. But the sources pointed out a really interesting anomaly there. The malls are empty.
Specifically, the shopping districts that used to cater to Chinese tourists. This is the geopolitical layer of the story. You would expect Chinese tourists to be flooding into Tokyo to buy luxury goods at a huge discount. But they aren't.
Because of politics.
Tensions over Taiwan, historical grievances. Beijing has effectively cooled that flow of people and money. So you have a shrinking domestic population, and the one neighbor who could plug the gap with tourism dollars is staying home. This leads to phenomena like the IKEA.
The ghost houses.
Right. There are millions of abandoned homes in the Japanese countryside and increasingly in the suburbs because the people who live there died,
Yeah.
and there's no one young enough or interested enough to move in. It's a physical manifestation of the debt problem.
Okay, connect that back to the debt for me.
It's the treadmill problem. To pay off $10 trillion in debt, you need economic growth. You need more workers paying more taxes. But Japan has fewer workers every single year. The median age is nearly 50. There are more retirees drawing pensions than there are kids preparing to enter the workforce.
So the tax base is shrinking, but the costs, healthcare, pensions, debt service, are all skyrocketing.
Exactly. You cannot grow your way out of debt when your workforce is disappearing. It is mathematically impossible. Unless you have some kind of productivity miracle, like everyone suddenly getting replaced by super efficient robots.
Which, to be fair, is always the Japan hope, isn't it? That the robots will save them.
And they are leaders in robotics, for sure. But technological substitution takes a long time. The debt crisis is happening now. The bond yields are rising now. The robots aren't ready to start paying taxes just yet.
So if the math is impossible, how does this end? We promised the listener we'd look at the scenarios, where the sources laid out a few paths, and none of them look like a parade.
No. The most optimistic path is something we could call managed decline.
That sounds pretty depressing. Managed decline.
It sounds bad, but it might actually be the best case. It means Japan accepts it's no longer an economic superpower. They accept slightly lower living standards. They inflate the currency slowly to eat away the real value of the debt over decades. It's a slow bleed, but it avoids a massive heart attack.
It's the museum economy scenario. It's a nice place to visit, everything works, but it's not growing anymore.
Precisely. But even that requires the bond market to cooperate. If the market panics, if that whale loses control, we get the other scenario. A hard reset.
What does a hard reset look like?
It looks like a currency collapse.
Yeah.
The Bank of Japan loses control of the yield curve. Rates spike to 3, 4, 5% naturally. The government becomes insolvent because it simply can't pay the interest. They either default, which is unthinkable for a G7 nation, or they print so much money to pay the debt that the yen basically becomes confetti, hyperinflation.
That feels like something that happens in, failed states, not in Tokyo.
And that is why the entire world is watching so closely. Because if it can happen in Tokyo, where the institutions are strong and the people are wealthy, it changes the rules of the game for absolutely everyone.
And this is a canary in the coal mine concept you mentioned.
Yes,
Yeah.
Japan is just the first to get there. But look at the rest of us. Europe has aging demographics and high debt. China is aging faster than any society in history. Even the U.S. is racking up debt at a record pace while our demographics slow down.
So we're basically watching a preview of our own movie.
We're watching a live case study of what happens when the era of free money collides with the hard reality of demographics. Japan is about 10 to 15 years ahead of Europe and maybe 20 years ahead of the U.S. If they can't engineer a soft landing, it suggests there might not be a soft landing for the rest of us.
That is a very sobering thought. I do want to circle back to the opportunities, though, because we mentioned that some investors diving in. If you're a contrarian, is this the time to buy Japan?
Oh, there's a massive argument for that. Warren Buffett has been buying up Japanese trading houses. The argument is, look, the companies are real, Toyota is real, Sony is real, they have cash, they sell globally. If the yen is cheap, these stocks are on sale.
So if you can stomach the currency risk, you're basically buying high-quality assets for pennies on the dollar.
Exactly. It's a minefield, but there could be gold in that minefield. But you have to watch that bond market. That 10-year yield is probably the most important number in global finance right now.
It's funny, I started this deep dive thinking about U.S. politics, and I'm ending it realizing that the most important chart in the world might be some boring bond yield in Tokyo.
That's usually how it works.
Or
The boring stuff is what gets you in the end.
So final takeaway. The background noise has officially become the main event. The furniture is, if not on fire, certainly smoking.
It is smoldering. The Widowmaker trade, which was betting against Japanese bonds, has finally started to pay off. The 0% credit card has been canceled. And the world is about to find out if the fourth largest economy can actually pay its bills.
A $10 trillion question. We'll be watching those yields. Thanks for breaking down the scary math with us.
My pleasure. Just keep an eye on that seesaw.